food, energy, and housing, the three most inflated asset classes. So we're rapidly approaching the rubber hits the road moment, and the Fed is running out of tools. What do? Do you stop buying bonds? Do you taper? Do you try and normalize the balance sheet? If you do, everything tries to find fair value in a environment where that has been massively distorted. What that means is everything deflates massively. Or do you continue to prop up the system through low interest rates and easy money, and create more and more and more price distortions where assets go to absurd levels, and who's going to be the person holding the bag when the music stops? This is a very dangerous environment, and that's why maybe they kept him on and brought her on as a sidekick, because maybe they need to start trying something new. But if I had to guess, tapering will not happen. Interest rates will not rise on their watch, at least if they have anything to say about it. Interest rates will only rise when the market forces take over, as it's supposed to. Interest rates are supposed to be found in equilibrium by the marketplace, not by central planners, and it will end badly. And you can see that already by what's happening to asset prices. They are becoming stratospheric, and finding real price discovery is next to impossible. You know that as you're looking for a home, and you know what the house prices are, and is it justified? Do you think, well, could it correct? Am I going to be left buying a home that was so much more than it really is worth? The home that I bought here in Florida, the houses around me are already going for almost double what I paid for my house, and this has been in 10 months. So I don't know. At what point does it just become complete and pure insanity? We're getting to that point, and I think if you try and taper like they talk about, the whole thing will throw up. The whole thing will implode. They can't do it. It's inflate or die. In other words, another way of saying that, it's inflate or default. And I think they will choose the path of inflation forever. And the only way that they can to mask this is to keep interest rates down. Well, Gibsons Paradox says if you keep interest rates down, gold should go up. Well, got to kill that canary too. The problem with that is that in the past, when they were killing that canary, no one was buying gold and silver. Now the whole world is. And I think the world is becoming wise to what's happened just the other day. And it's gross, the amount that it was settled at. But just the other day, we find out that, three banks paid $152 million for rigging the London fix. This is why you see the AM and the PM fix crash down every single morning as it leaves London and as it enters New York, or when London opens and as it's entering New York. At the end of the day, Dimitri Speck has done a wonderful job at showing how the market just waterfalls over an extended period of time, literally every single day at the AM and the PM fix. Well, the banks are suppressing the price. And it was originally done for Gibsons Paradox, to keep interest rates low, to create a perception or illusion of reality. But as you get closer and closer to the end of the game, as asset prices become so out of whack and so unjustified, and you see all these misallocations of capital, you get to a point where you have to, at some point, something has to break. Either the dollar breaks or everything else breaks. Just depends which route that they choose. And my guess is they will choose to continue to destroy the dollar in favor of blowing up the economy and everyone's assets until something happens that forces their hand. And what is that event? Is it like we talked about, OPEC revaluing oil and other currencies? I don't know what it is, but I do know we are entering Alice in Wonderland level as it pertains to asset prices, and it's all courtesy of the environment that we have seen over the past 20 months. Here again, they're talking about, between the Build Back Better and the infrastructure bill, another $4 trillion, where 2/3 of it goes to stupid woke issues, and very little of it goes to building back the infrastructure. So, Dunnigan, I think if they were able to keep doing this forever, we'd see gold at $1,000 or under. We'd see silver at $8 or $10. It continues to ratchet higher, little by little by little, in a very frustrating and counterintuitive way, until one day we wake up and it's not. And it's just like when they ask Hemingway how he went broke. little by little, then all at once. And that is what will happen. It's 2 steps forward, 1 step back. Aggravate the hell out of me that it is counterintuitive and it collapses after I buy it, but it doesn't matter. It continues to march higher, and the biggest money in the world continues to buy it, using price as a misdirection, as a tool of misdirection. If I didn't see the massive purchasing by the central banks, by the commercial banks, by the sovereign wealth funds, by the big money, then I would be less inclined to be so optimistic. But what just happened the other day was a almost like panic on the behalf of the commercial banks to drive the price below the moving averages, to get the managed money, who was really in record territory, to sell so they could gobble up all of those sold long positions and issue the new short positions, taking the other side. So you have the commercial banks now positioned for a nice rise in the metal heading into the end of the year. And I think everyone's talking about some of that's going to happen at the end of the year. Maybe this is what it's about: repositioning, getting out of their short positions, forcing the managed money to sell so they can reposition in anticipation of much higher prices towards the end of the year. Things that would normally be expected to dramatically boost gold and silver prices, such as the massive demand in retail and industrial applications. Heck, you just got the Silver Institute, who just came out and estimated this week that the global silver demand would be over 1 billion ounces for 2021. And with what's coming out of the ground, it's somewhere just north of 800 million ounces. Here again, we're going to be in deficit. Or talking about the sudden threats of mines being shut down in both Mexico and Peru for environmental reasons. Or maybe it was the fact that the Indian imports are going crazy in silver. All of this has been brushed aside in what is a deliberate and intentional drive-by shooting of the gold and silver prices. And, you know, here again, it gets old and repeating the same thing, but you can only fool the physical market for a limited time. People who say, well, can they do this forever? Look, if that were the case, gold would still be $1,000 or less, and silver would still be $8 or $10 or less. At some point, the physical demand overwhelms the ability to keep the price down. If you look at what happened, you had the commercial banks engineering a price decline almost in a feverish way, as if they are expecting something big coming, to push the price so dramatically down through all of the moving averages. Really what it did was it enticed a tremendous amount of managed money selling. Well, who's buying those contracts that are being sold by the managed money traders? And that is the commercial banks. So they engineer the price down. They get the ball rolling through the moving averages, which trigger the algorithms that the managed money traders have running their funds, and bang, everyone sells. That took the losses that the commercial banks have right now down $2 billion. They're still $8.6 billion in the red on both gold and silver.